What's up, you guys? It's Keith from Stock Hours here, back again with another educational video. Today we're going to be going over different chart patterns, which ones are my favorite, which ones do we kind of trade the most, and how to execute on these patterns. I want you guys to make sure that you're actually paying attention to what these patterns look like and memorize these patterns so when you see them on the chart, you can really take advantage of them. So let's get right into it. So we're going to be going over the bearish and bullish version of each of these patterns. Bullish, if you guys don't know, bullish is upside, bearish is downside. I know that's pretty basic, but I figured I would let you know. Like I said, we're going to be going over each version of all of these patterns. And yeah, the first pattern that we're going to talk about here is called the bull flag. So what this is really kind of a continuation pattern. And when you see this pattern, you're generally going to see an impulsive bullish move to the upside. And then at the top here, we're going to see the stock take some sort of a breather. So you can already see here, the first part of this pattern is the flag pole. This is why it's called the bull flag. This is the flag pole, and our retracement here is going to be the flag. So there's a couple different ways that these patterns can be executed and formed. First, we're just going to go over the most basic version. You have the impulsive bullish move here, you have your retracement, and now you see we're forming some sort of a downtrend channel. This right here is the flag. If you could imagine a flag on a flagpole, this is kind of the same concept. So how this pattern is generally played is people will look to enter at the break of this downtrend, right? This will generally be the entry spot. The target will be somewhere above the previous high, depending on the momentum we get into that level. So your stop loss is going to be right around this previous support that we made. So this is how people generally execute on a bull flag pattern. Now, the revision of this pattern that we usually see more often and the way that we like to execute on this is called the inverse H pattern. So you'll see the same impulsive move to the upside, you'll see your retracement, and then you will see that we are starting to make that downtrend, right? Right here, we've already started to make that downtrend. But we are not looking to enter on the break of the downtrend. We are looking for the confirmation of this breakout, which is at this previous high. So the reason we do this is because a lot of times you will see we will try and break out of these trends right here, but when we break out of the trend, we'll very quickly wick back in and get stopped out very quickly. So what we like to do is look for the actual momentum off of the break of that downtrend and then enter here at this previous high. And then once again, our target will be somewhere above the previous high. So that is the safer way to play those types of patterns and the way that we generally like to do that. Once again, your stop loss is still going to be right around this previous support level. So yeah, that is a continuation pattern. That is the bull flag and the inverse H. The reason we call it the inverse H is because it kind of looks like an upside down lowercase h. These patterns are usually formed over generally like a 1 to 3 minute period with an inverse H. These bull flags can be formed over a very, very large time period. If we're looking at the 1 minute chart though, these inverse H patterns are usually formed between a 1 to 3 minute period. Next, we're going to go ahead and get into the bear flag. It's the same concept, but to the downside. So you see our flagpole right here, the impulsive bearish move with a retracement, and you will see we will start to form an uptrend channel. You'll see we're making higher highs, higher lows, which is not what you want to see when you're looking to play something to the downside. But you see we've got our uptrend here on the top side, our uptrend here on the downside, and boom, entry level is right there at that downtrend break, and then your target is somewhere below that previous low. And we have our pattern that we generally like to play called the H pattern, where it is the same concept, but we're looking for the actual confirmation of that level before we get in. So our entry level is at the previous low, targeting a push below the previous low once again. But this is generally the safer way to play these types of patterns. So I'm going to actually backtrack here and show you guys an example of a bull flag or a bear flag. Let's just hop on the charts here and see if we have anything that fits that bill. I guarantee you we can find one within a second. Okay, so perfect example right here. Google. You see you have the flag pole type of move right here. You have the retracement right here, which is the flag where your downtrend is at. Boom, right here. The downtrend breaks. You have the confirmation of that break, which is the inverse H, right? And what happens after it breaks that? Boom, price shoots. So that's couldn't be more perfect. These types of patterns are super easy to see on the charts, and you can find them on larger time frames as well. Okay, so here's one right here. Here's a bear flag on the 15-minute time frame on Tesla. You see we have our large bearish move right here, followed by a bounce, which is the retracement. Here's our uptrend that we're breaking, and then continuing to the downside. Our entry level on this would be on the low of this original flagpole, and look what happens after. We have a flush all the way down to 198.45. So that is a live market example of a bull flag and a bear flag. If you guys can identify these while trading, it is going to help you out a lot in the long run. And I guess we probably should have started with this, but generally, when you see uptrends or downtrends, depending on where the stock is at in correlation to the trend, right? These are generally looked at differently. So it's not going to sound like it makes much sense until you really think about it. But generally, when we see a downtrend, that is a sign that we're going to break to the upside. And generally, when we see an uptrend, that's a sign that we're going to break to the downside. If our stock is below the downtrend, right, we're generally going to be seeing a break on this to the upside. Same thing. If our stock is above the uptrend, we're generally going to see a break to the downside. This is going to lead us into our next pattern called a channel. This is where you're going to see a consolidation between two price levels in an either downtrend channel or an uptrend channel. So we will generally see that when we get to either this downtrend here, we will have a bounce, or this uptrend here, we will have a rejection. That's because when price gets to these levels, we're generally overextended by the time we get there. So it's very hard for price to actually break out of these. And like I said, I know it sounds backwards, but the reasoning that we generally see downtrends break to the upside or uptrends break to the downside is because by the time we get to the top of those trends, the stock is too overextended to continue in this direction. So that is a downtrend channel and an uptrend channel. The next thing we're going to get into is an ascending wedge and a descending wedge. So an ascending wedge, you're going to see basically the same concept as an uptrend channel or a downtrend channel here. But an ascending wedge, you're going to see that we are making higher highs and higher lows consistently in the form of a channel, but you see we have a uptrend here, we have an uptrend here as well. So this is where we're going to generally see by the time price gets to the top of these ascending wedges, they will generally break to the downside. Once again, because the move is so overextended by the time it gets to the top of these, price has to go somewhere, and the easiest way for it to go is down. Just pretend you're climbing to the top of a ladder, right? When you get to the very top rung of that ladder, if you keep trying to climb, you're just going to fall off the other side. It's the same type of concept here. So that is the ascending wedge, and this right here would be the descending wedge. This right here is the descending wedge. Boom. There's your wedge. And then by the time we get to the bottom of this wedge here, you will generally see price break out to the upside. We are going to go over the consolidation pattern. So the consolidation pattern is generally a 50-50 guess on where price is going to go. This is where buyers and sellers are kind of fighting to keep the price in the same area. They're not fighting. They're actually in an agreement on price, right? Until one side decides that they want to take price elsewhere, they are basically in agreement on price in between this range. So this is a type of pattern that you don't want to get caught in because, like I said, it could go to either way. So like I said, you could either break out to the upside on these, you could break out to the downside on these. This is basically a 50-50 guess, which is why a lot of the times when stocks are in like a rectangular consolidation, you generally do not want to be a part of that trade. Next, we're going to get to another reversal pattern here, which is a head and shoulders pattern. So I like to play these a lot. They happen on large time frames, they happen on small time frames. It doesn't really matter. The ones that are on the smaller time frames, obviously I'm going to count more as a scalp. The ones that are on a larger time frame, I'm going to count more as a possible day trade, where I'm holding for longer, looking for a larger target. But this is basically characterized by a bullish move to the upside here. You create some sort of resistance right here. And what are we forming right now? What does this look like we're forming? We just went over this. It looks like it's forming an inverse H right here, which it is. You have your support, or you have your resistance right here. You have your support right here. And now we're breaking out of that resistance to the upside. This is where we are topping out on price and creating the head of the pattern. So now we are going to retrace to our previous support here. We have another bounce, and what are we forming here? Boom, we're forming an H pattern or a bear flag, whichever one you want to call it. So on this, you would be looking to enter at the neckline of this pattern. So you have your shoulder, you have your head, you have your other shoulder, and this is your neckline. This is where you generally want to enter on these patterns. And on these patterns, I would generally target the original area where this move started with a stop loss of above this previous resistance we made. So that is a head and shoulders pattern. That is a bearish reversal pattern here. And next we're going to get into the inverted head and shoulders, which is a bullish reversal pattern. So you will see we make a large bearish move to the downside. We create our first area of support. We bounce. We make a resistance right here. And what are we forming? We're forming an H pattern. Then we have our continuation right here, creating the head of the pattern. You can generally start to recognize these patterns whenever you are about at this point right here, where you're retesting that previous resistance, and then rejecting, and then what are you making? An inverse H right here. That is creating your neckline for the inverted head and shoulders pattern. So once again, your entry is going to be at the neckline, generally targeting the start of the original move with a stop loss of right below this support. So you see, once again, shoulder, head, shoulder. And if you were to take your phone or computer or whatever and flip it upside down, it looks exactly like what I drew the first time. So these are reversal patterns that I like to use. You can also have consolidation reversal patterns to either direction. Like I said, how it can go 50-50. You can either have a consolidation where it is a continuation pattern right here, like something like this. I'm going to redraw that, make it a bit more even. So you have your bullish move here, you have your consolidation here, and then you can see price come right up here and continue that move, right? That is a continuation pattern that you can see from a consolidation. But you can also very easily see the same thing as a reversal pattern. So you have your big bullish move here, you have your consolidation here, and then you have your reversal on that. Generally, whenever you see a consolidation as a reversal pattern, you will see that we're kind of rounding out at either the top or the bottom of this. So to the upside, you would see that we're rounding out above the top, where our candles are kind of creating wicks in a form where it's showing us like, they're breaking price above and they are trying to get it above this level, but every time we do, we wick right back down. Once again, you see that we're kind of rounding out here and creating momentum back to the downside. Same thing with this to the upside. We generally see the consolidation have some larger wicks to the downside, and they're just trying to break it out of this consolidation range. But at the end of the day, we are just rounding out and making kind of a just flat top resistance point there. So those are the kind of consolidations that you can kind of judge as a reversal. And I would not be looking to enter one of these patterns until we get to, like I said, the flat top resistance or the flat bottom support with momentum and the market giving us some help in that direction. So there's consolidations, ascending wedges, descending wedges, bull flags, bear flags, head and shoulders, inverse headed shoulders. And the last patterns we're going to get into here are the ascending, descending, and symmetrical triangle. So I'm just going to draw all three of these out here. This is where you are going to see a flat top, a flat bottom, or an equal move to either side. So when you're seeing an ascending triangle, different than the ascending wedge, you will generally see that this is a continuation pattern to the upside. This is generally this is generally a bullish pattern. So you will see that price comes up and it rejects consistently off of the same price while making higher lows. So you see we're rejecting off the same price, making higher lows, and boom, we break out right here. That is an ascending triangle. If my lines were a little bit straighter, then you would be able to tell a very clear difference. But like I said, we are looking for this to break out of that flat top that we have formed. Same thing with a descending triangle. We have our bearish move here. We have our lower highs where we're we're bouncing off of the same flat bottom support each time up until we finally end up breaking below that. So on these patterns right here, your entry would be at this flat top or at this flat bottom, and your stop loss would generally be this previous support right here or this previous resistance right here. So your risk to reward on these types of trades are very, very easy to see and also very, very tight. Now, the difference is a symmetrical triangle can go in either direction because you have an equal consolidation between both sides. So this is where you will see we have lower highs, higher lows, lower highs, higher lows. So we're kind of fighting between trying to uptrend and trying to downtrend. Sometimes you can see these as continuation patterns to the upside or continuation patterns to, or continuation patterns to the downside. So the symmetrical triangle can really go in either direction, which is why it's a bit more difficult to judge these types of patterns here. But once again, to differentiate the ascending and descending triangle from the ascending and descending wedge is you have your flat top versus your uptrend on the upside and your uptrend on the downside. This is going to create overextension in the move, where this is going to create basically a squeeze where you're getting squeezed out of this flat top. This, once again, descending wedge is going to create overextension in the move to the downside, where you're generally going to have to see price retrace, just like this. So, yeah, I hope these all made sense. Make sure you guys drop a like, comment, and subscribe on this video if you want to see more. If you have any questions, feel free to DM me on Instagram at Keith Trades. And I hope you guys enjoyed. Make sure you drop a like, comment, and subscribe, and turn on your notifications so you don't miss next week's charting session at 8:30 Eastern on Wednesday. So hope you guys have a great rest of your week. Peace.